Hello and welcome to this month's Trade Floor Update. I'm Rob Mead, Portfolio Manager. I'm joined by Adam Bowe, one of my colleagues on the desk. As you can see, we're still on the trade floor, we're still operating business as usual. There's a few less of us here than normal, but to give you full comfort that the PIMCO trade floors all around the world continue to operate, and we've put in place multiple different contingency plans in order to ensure we can still manage the portfolios seamlessly. What we wanted to do today, given that there's so much noise, given that there's so much sort of going on around the market, we wanted to take this opportunity to provide some clarity. And we wanted to sort of give you some takeaways to think about when you're investing and you're managing your clients' assets. So what I wanted to do first was have Adam give us a little bit of a backdrop around what's happening with policy, what's happening in economies, and how we think that's likely to impact markets.
So over the past couple of weeks, I think one of the defining characteristics of this period of volatility has been a lot of dislocations in parts of the bond market we don't typically see it. So particularly in the government bond space. So a lot of dislocations at the curve, periods of illiquidity where we're not used to seeing it. So transaction costs have been a little higher, and huge amounts of intraday volatility. And it hasn't just been the Australian bond market and the Australian semi-government bond market, but that's been around the world. So subsequently, we've seen a huge response by policymakers. So on the fiscal side to start with, we've seen a huge fiscal expansion from our own federal government, totaling up around 10% of GDP, what they've announced so far. So it's been swift and it's been meaningful. And that's really to underwrite the economy through this period where we have to essentially go into hibernation with the businesses as they've described it. And then on the monetary policy side, the RBA in recent weeks has taken significant steps to also support the economy through this transition, but also to bring back some liquidity and normal market functioning to the government bond market, semi-government bond market in particular. So the riskless curve is obviously a really important financial instrument for all pockets of the financial markets. So they've cut rates to 0.25%. They've targeted 3-year bond yields at 0.25%. So buying bonds out to 3 years to pin rates there. Very strong commitment to how long they're going to keep policy rates on hold at these low levels. And then committed to an unlimited bond purchase program, including Commonwealth government bonds and semis, to help pin rates where they want them, but also to bring back some normal functioning, liquidity, less volatility in the government space. So a huge policy response. So on the one hand, we've got 10% fiscal expansion. That's a lot of bonds that are coming to the market. But on the other hand, we've got the RBA in the market every day so far since they've announced it, and they're purchasing bonds at roughly a rate of 1% of GDP at the moment. So it's a huge support to the financial system and the functioning of the government bond market. So we've seen some volatility, some really wild swings in mark-to-market and noise in valuations. We're starting to see that normalize. Now we would expect that to continue as we get through quarter end. Some normalization of the functioning of bond markets, particularly the domestic one, over the coming weeks.
And how would you sort of differentiate the reaction function from, say, ECB, the Fed versus the RBA?
Yes, it's a good question. I think the RBA's approach looks very similar to those central banks when they first reached the lower bound and they first started engaging in quantitative easing. So there's no some important differences. There's no purchases of private sector assets, credit, corporate bonds, asset-backed bonds, although the AOFM is providing some funding in the RMBS space, particularly to the non-banks. But there's no corporate purchase program. So we're starting to see some normalization in investment-grade credit markets in those markets where the central banks are engaged in Europe and in the US. We haven't seen that so far from the RBA. So the credit markets here are just taking a little bit longer to normalise. So still some attractive opportunities in that space, certainly.
Yeah, I think that's a really good point, and it's something that we're speaking with our clients about quite a lot, in the sense that you have seen a bit of a stronger recovery in credit markets outside of Australia, yet they're even global credit markets still representing tremendous value. One of the interesting things that Adam and I and the team have been talking about is sort of how the Australian footprint is a little different. So here we've had very strong weakness, or very, very significant weakness, I should say, in the Australian dollar, which has impacted currency hedge costs. We've also seen a sort of a different reaction function from the RBA, as Adam mentioned, leaving some sectors of the market to fend for themselves to some degree. And then we've also had this policy announcement around allowing access to super early. So all of this sort of leads to a little bit more uncertainty, arguably, in Australia than we've seen in other jurisdictions. The great news is from that is we think there's tremendous opportunity here. We think the policies that Adam talked about are designed to ensure that our most important sectors of the economy can bounce. So whether that be tourism, whether that be education, whether that be commodities, or whether that be the most important element of the economy being the consumer. So all of those policies are designed to allow us to bounce when this phase ends. As a result of that, we do think high quality credit remains very attractive. When your starting yields are in the sort of very low single digits or in basis point terms, there's some tremendous opportunity to add a bit of yield, add some income. So I think that probably wraps up our sort of areas that we wanted to cover today. We just wanted to reiterate, expect more mark-to-market volatility. We know in markets are slowly getting back to normal, but this will take time. And we are very confident that in the long run, fundamentals will win the day. So we're sticking to our belief that if you're making the right investment decision, while you might have to put up with some noise in the interim, those decisions will pay off in the long run. So let me say once again, thank you to all of you for all of your support. If you need any further information, please don't hesitate to contact your PIMCO account manager, and we look forward to presenting to you again next month. Thank you very much.
Thank you.